You made an extra mortgage payment last month, maybe two. You printed out the payoff schedule, ran the numbers, and felt like exactly what a smart person does when they're trying to get their financial life together. Here's the problem. That decision, the one that felt so right, might be one of the most expensive financial mistakes you make in your 40s or 50s. Not because debt is good, not because paying off your house is wrong in every situation, but because after a certain age, the math changes completely. And most people are still following rules that were written for a completely different financial era. Before I show you the four-step path that actually builds wealth in midlife, I need to show you what that extra mortgage payment is quietly costing you. Because once you see the number, you cannot unsee it. I'm Jack. This is Midlife Money, and this one could change the way you think about every dollar you have left to deploy. Let's start with something most financial advice gets completely wrong. Not all debt is the same, not even close. There are two types of debt in your life right now, and the mistake most people make is treating them identically. The first type is what I call financial cancer. Credit card debt at 19 or 22%, personal loans at 15%, buy now, pay later balances quietly compounding in the background. This debt is aggressive. It is working against you every single day. And there is no investment strategy on earth that reliably beats a guaranteed 22% return, which is exactly what you earn the moment you eliminate it. If you have this kind of debt, it is your number one priority. Full stop. The second type is what I call structural debt. Your mortgage, a low-interest auto loan. Debt that is fixed, predictable, and sitting at 3, 4, or 5%. This debt behaves completely differently. And after 60, your relationship with it needs to change. Here's what most people don't realize. The strategy that makes sense at 35 is not the strategy that makes sense at 55. And if you are applying the same rules to both, you are leaving serious money on the table. Now let's talk about the debt-free gospel. You know it. You've heard it your whole life. Pay off the house, eliminate every penny of debt, enter retirement with a clean slate and a sense of freedom. That advice came from a real place. In an era of high mortgage rates and limited investment access, paying off debt was often the smartest guaranteed return available. But that era is over. Today, someone with a 3.5% mortgage and the discipline to redirect extra payments into a low-cost index fund is not being reckless. They are being strategic. They understand something the debt-free gospel never accounted for, that every dollar has a job, and sending it to the bank may not be its highest value assignment. The problem isn't debt. The problem is expensive debt in the wrong season of life. So what do you do instead? Here's the four-step path. Step 1, eliminate the financial cancer first. Before anything else, before extra mortgage payments, before increasing your investment contributions, before any of the next 3 steps, you wipe out high-interest debt completely. If you are carrying credit card balances, that is your entire focus until they are gone. Not because of the emotional weight, because of the math. A 20% interest rate compounding against you every month is a fire. You do not optimize your portfolio while your house is burning. Once the high-interest debt is gone, your cash flow changes, and that changes everything that follows. Step 2, build the liquidity floor. This is where most people in their 40s and 50s make the critical error. They take every available dollar and throw it at the mortgage. The balance drops, the payoff date moves closer, and it feels like progress. But here's what they've actually done. They've taken liquid, accessible money, money that could respond to an emergency, a market opportunity, a medical event, and they've locked it inside the walls of their house. You cannot pay a hospital bill with home equity. You cannot cover 3 months of expenses with a paid-off mortgage if you have no savings. Being house-rich and cash-poor is not financial security. It is fragility dressed up as responsibility. Before you make a single extra mortgage payment, you need a liquidity floor. At minimum, 2 years of living expenses in accessible cash or cash equivalents. High-yield savings, short-term bonds, something you can reach without selling investments at the worst possible moment. That floor is not idle money. That floor is your protection against becoming a forced seller when the market is down, which brings us directly to step 3. Step 3. Understand the spread and use it. This is the step that changes how you see your mortgage forever. Your mortgage has an interest rate. Let's call it 4%. The S&P 500 has returned an average of roughly 10% annually over long periods. The difference between those two numbers, that 6% gap, is called the spread. And that spread is where wealth gets built. Every extra dollar you send to your mortgage earns you a guaranteed 4% return. That is not bad. But every dollar you redirect into a diversified index fund has historically earned more than double that over time. On $500 a month over 15 years, the difference between a 4% return and a 10% return is not small. It is the difference between roughly $124,000 and $207,000. That is not a rounding error. That is $83,000. Now picture that same scenario, but inflation is running at 4 or 5%. Your mortgage balance is shrinking in real terms every single year. You're paying back the bank with dollars that are worth less than the ones you borrowed. That 4% mortgage is now effectively costing you almost nothing. The math is not even close. Step 4. Build the reinvestment path and make it automatic. This is where the strategy becomes a system. Take the dollars you were sending to your mortgage as extra payments and redirect them into a simple, automatic investment plan. If your employer offers a 401k match and you are not capturing the full match, that comes first. That is an instant 50 to 100% return. Nothing in personal finance competes with it. After the match is captured, the priority order looks like this. Max your HSA if you have access to one, triple tax advantage, and healthcare will be your largest retirement expense. Then your Roth IRA or traditional IRA, depending on your tax situation. Then your taxable brokerage account in low-cost index funds. You do not need to pick stocks. You do not need a financial advisor charging 1% of your assets every year. You need a total market index fund, consistent contributions, and time. Think of it this way. Your mortgage is a locked vault. The equity inside it is real, but it is not working. It is not compounding. It is not generating income. It is sitting there, waiting. Meanwhile, a diversified portfolio is a working vault. Every dollar inside it is producing returns that produce more returns. That is compounding. And after 60, compounding is the only tool powerful enough to close the gap. Here's what this comes down to. The debt-free gospel was not wrong for everyone, but it was built for a different time, and it was never designed for the specific financial reality of someone in their 40s or 50s trying to build real wealth before retirement. Step 1, eliminate financial cancer first. High-interest debt is the only debt that deserves your full aggression. Step 2, build your liquidity floor. 2 years of accessible cash before a single extra mortgage payment. Step 3, understand the spread. Your mortgage rate versus your investment return is not a tie. It is not even close. Step 4, build the reinvestment path. Redirect those dollars into an automatic, low-cost investment system and let compounding do the work. The goal is not to be the most debt-free person in the room. The goal is to have enough money to live with dignity and options in the second half of your life. Those are not the same goal, and one of them will serve you far better at 75. If this reframed the way you're thinking about your mortgage, hit like and subscribe. I put out a new video every week built specifically for where you are right now. And drop a comment below. Are you team pay it off or team keep the cash? I read every one. See you in a few days.